Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Oracle stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 316 billion market cap. They're trading at $115 a share and they have 2.8 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had a lot of free cash flow in 2021, close to 14 billion, dropping to 5 billion in 2022. It came up to 8.5 billion in 2023, then up to 10 billion in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that has the same exact trend. Really close numbers too. Every year it's really close except for 2022. You don't usually see that too often. Revenue is the sales for the company and that grows nicely from 40 billion to 51 billion. You can see they had the most growth in 2023, 18%. We estimated 4 years of future free cash flows. We also estimated a terminal value, it's all cash flows past year 4, that's 249 billion. We discounted the numbers back to today using the weighted average cost of capital. We get a value of the company of $221 billion. We divide that by 2.8 billion shares. And we get a calculated stock price of $80. They're trading at $115, so they're trading at a 43% premium. It's a strong sell according to the model. There are 146 companies in the same industry as Oracle, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a lot on CapEx, $6.9 billion. The only company bigger is Microsoft. They're really leveraged. For every dollar of equity, they have $23 of debt. They're one of the few companies that pays a dividend in this industry. They generate lots of free cash flow and a really big market cap. And they're really far behind Microsoft, as every company in the world is. They have a pretty bad price to book. A good PE, better than the median average. Price to free cash flow is between the median and average. Same thing with their price of sales. They generate a ton of revenue, 52 billion. They're not really growing too much anymore. Their 5-year annual revenue growth rate is only 6%. Let's take a look at their most recent 10Q. This is their income statement from the third quarter of 2023. Their revenue in the third quarter is 13 billion. In the third quarter of 2022, it's 12 billion. This is for the prior 2 quarters in 2023, 25 billion. Of the 13 billion, 10 billion is from cloud services and license support. 1.2 billion from cloud license and on-premise license, 800 million from hardware, and 1.4 billion from services. Their revenue in the Americas is 8 billion, EMEA 3.2 billion, and APAC 1.7 billion. Their operating expenses are 9.3 billion. Cloud services and support 2.3 billion, hardware 200 million, services 1.3 billion, marketing 2 billion, R&D 2.2 billion. So total expenses 9.3 billion. Revenue minus expenses gives you your operating income 3.6 billion, up from 3.1 billion. They spent 888 million of interest on their debt, 217 million of taxes, so their net income is 2.5 billion, up from 1.7 billion. An EPS of 91 cents, up from 65 cents. They are adding shares. Last year it was 2.7 billion. Now it's 2.75 billion. Let's take a look at their balance sheet. Current assets of 19 billion. Current liabilities of 24 billion, so their current ratio is below 1. They may need to add some debt to get through the next 12 months. They have 8 billion of cash on their balance sheet, 6.8 billion of receivables, and 3.8 billion of prepaid expenses. A prepaid expense is when a company makes an advance payment for a product or service they're going to receive in the future. And their biggest asset by far is goodwill, 62 billion. Here's a breakdown of the goodwill. Of the companies they acquire, cloud and license was 57 billion, hardware 2.7 billion, services 2.4 billion. Their biggest acquisition was for Cerner in 2022. That was 28 billion. Cerner provides digital information systems used within hospitals and health systems. It is designed to help medical professionals deliver better health care to patients. Their total assets are 134 billion. Total liabilities 106 billion. Their biggest liability is debt, long-term debt of 82 billion. Assets minus liabilities gives you your equity, 4.4 billion. They raised 31 billion from selling their business. They lost $25 billion from running their business. The main reason they have an accumulated deficit is because they buy back so much stock. They should really separate out retained earnings and treasury stock. If they did that, you would see how profitable they are, but they combine them. Let's take a look at their statement of cash flows. This is for the trailing 6 months. Their operating cash flow is $7.1 billion. That's how much cash they generate from running their day-to-day business. Last year was $7.2 billion. The way you calculate that, you start with a net income of $5 billion. You add back the non-cash items on the income statement, $1.5 billion of depreciation, $1.5 billion of amortization. They pass through an income tax gain, so we minus that out here. They had $1.9 billion of stock-based compensation expenses on the income statement, so we add that back here. They had a cash outflow of $1 billion in accounts payable. This means they bought on credit in the past and they're paying for it this accounting period. And they had a cash outflow of $1.5 billion in income taxes payable. In their investing section, they spent $2.4 billion on PP&E. Last year was $4.2 billion. They didn't spend much on acquisitions. Last year they spent $28 billion. That was for the acquisition of Cerner, because sometimes companies acquire other companies with stock, sometimes with cash, sometimes a combination. They did all cash, $28 billion. That's why it shows up in the investing section. If they acquired them with all stock, you wouldn't see anything in the investing section. But how did they get so much cash? Where did they get the $28 billion? Well, the answer is pretty obvious. They added $28 billion of debt. Most companies don't have $28 billion of cash on their balance sheet. Berkshire Hathaway does, Microsoft does, but this company doesn't have that much cash. So they had to take on debt. Let's look at their financing section. They bought back $1 billion of stock last year, $600 million this year. They paid out $2.2 billion in dividends. Last year, $1.7 billion, and they paid back $3.5 billion on a senior note. Let's look at the company on Simply Wall Street. Its last price, $115, $315 billion market cap, up 5% in the past week, up 29% in the past year. Let's see what they say about the company. Oracle offers products and services that address enterprise information technology environments worldwide. They own NetSuite, which is like QuickBooks on steroids. They have Oracle Cloud SaaS. SaaS is software as a service. Oracle Fusion ERP. ERP is Enterprise Resource Planning. They were founded in 1977, headquartered in Austin, Texas. Here's a stock price since they started trading. Look at that big run up into 2000. If you bought it at the peak in 2000 around $40 a share, it would have taken about 17 years to make money on the stock. But it's done really well since then. Its peak was $127 just a few months ago. Simply Wall Street is real bullish on this one, 172. They say the stock is 34% undervalued. 30 analysts priced this stock at $124. They also say it's undervalued. Their 2024 revenue is projected to be $53 billion, 2025 $58 billion, 2026 $63 billion. The reason they have such a poor debt-to-equity ratio is because their debt is $89 billion and their equity is only $4 billion. Looks like a pretty weak balance sheet. Look how much their cash has gone down. It was $71 billion in 2017. Now it's down to $8.7 billion. Their dividend yield in 2014 was 1.2%. Then it got close to 2%. It's been around 2% between 2016 and 2022. It is down a little bit now as the stock price has been coming up. The forecast is 1.4% by 2026. The CEO's annual salary is $950,000, total compensation $5.3 million. Their tenure as CEO is 4.3 years. There's been no insider buying the past year, just selling. 44% of the company is owned by institutions, 42% by insiders, and 15% by the general public. Larry Ellison is the biggest shareholder. He's the founder. He owns 42% of the company. His value is $131 billion. He really believes in the company. He hasn't sold out. If Bill Gates never sold out, he'd be worth over $1 trillion today. I think he owned half the company at the beginning, so he'd be worth $1.5 trillion today. They employ lots of people, 164,000 currently, and the ticker trades in lots of places: the New York Stock Exchange, Mexican Bolsa, Deutsche Börse, Xetra, Santiago, Swiss, EuroTLX, Wiener Bourse, BATS, Europe, Buenos Aires, and Sao Paulo Bolsa. So let me know what you think. Give the video a like, subscribe, and comment below. If you'd like to get a custom valuation, just support the channel. You can become a member by clicking the link in the description below. Thanks for watching.